Hello, this is Rosen, your local real estate agent in Northern California. Today I just wanted to go over some real estate news and just talk about what that means for the market. So, the big news over the weekend is that mortgage rates plummeted, which is interesting for a number of reasons that I'm going to show you in this video. Basically, we went down from a 6.78 down to 6.47. So we had dumped about 0.25% overnight, which is actually a pretty big deal as far as rates go. It's been pretty volatile lately, but 0.25% overnight is pretty big and maybe an indicative sign of things yet to come. Let's take a look a little bit deeper and see what kind of information we can glean. So this is the 30-year mortgage rate in blue here. And you can see that we've had this big spike up kind of in the last few years. This is when COVID happened and they dropped rates real low, and then there was a big housing boom right there. So you can see that normally they drop rates. Oh, this red line here is the Federal Reserve's effective funds rate. And basically, this is how much you can get for a treasury bond, and then mortgage, being a more risky investment than that, will trade at a premium to that. So you can basically see it loosely follows this in red, and then the blue kind of follows that as well. It's not a great match, but you can see that they're loosely correlated. So normally what happens is when the economy goes into a recession, they lower rates to stimulate the economy, and then the mortgage rate follows suit. We've seen something actually kind of different this time, which is interesting, and I think it's actually not a great sign for the housing market. So you can see here that during the 2008 financial crisis, let me try to highlight the red, that funds basically dropped from 5.25 all the way down to 0, and then they stayed at 0 from 2010 to 2015. So that's a huge, it's actually the lowest rate in recorded history there. And you can see that the funds rate here, the mortgage rate, it did a slow decline from about 6%, and it kind of bottomed out here at 3.5%, and then it kind of just chugged along. So you can see that it doesn't track it specifically well. But what's interesting on this time, and let me just zoom in here, is that this time they lowered the rates before they had dropped the federal funds rates. That is normally not what happens. Trying to pull this up. So you can see here that it's been flat across the top of this lately at 5.33%. So, if I pull up the dot plot here, you can see that they are trying to lower it, or at least project expectations of lowering, which actually has a huge, profound effect on the market, not just lowering, but expectations. So they're going to be trying to lower this down into the 3% into 2026. And normally the interest rate here would follow suit, but the interest rate is actually preempting that move. There's been a lot of scuttlebutt about a lowering of Fed funds rate in September, and what I think happened, and the data will confirm this, is that nobody was buying houses, and that actually forced the loan originators to bring down their prices so that they can get more business. So we can see here that this is the average price. So this is for where I'm at in Santa Rosa. And we can see that the average price per square foot during the high here was up to, I'm just going to call it 598, and then now we've come down to 539. What my concern here is that as soon as they lower this and people catch wind, that means that houses are just going to start to tick right back up. And a lot of people have expressed that they want houses to come down even more. This is going to be 10, 11 and a little bit of change percent coming down. Well, an 11% decrease in housing prices is not enough for the average consumer to feel like it's a good time to get in. And if we come here, this is Fred economic data, and it's all transaction house prices for California. And you can see here that we'd peaked out in 2022. Let's go back to this. 2022. Mind you, this is for a little bit different area. But we did not see a huge correction. So what happens here is, look, house prices, they went down from $650 down to $550, almost $100,000 before we were officially in a recession. So if they're lowering rates here and they expect to lower rates next month, where's the recession? So what I'm a little concerned about now is that these is just going to keep shooting house prices higher. We've seen a huge wave of price reductions, and I just pulled a random house up in Santa Rosa that just kind of looked interesting, and look, this had a $100,000 price reduction. So that's a pretty big price reduction on top of a 0.25% interest. It'll actually save quite a bit of money. So I just went to this mortgage calculator here just to do a quick check. Interest rates had topped out at around, let's just go 6.9%. Let's just call it 7%. So this house was, I'm going to assume that you put $25,000 down. So this house was $675,000 at 7% for a total payment of $4,000, let's just call it $500, which is pretty hefty. So let's just check. In the last week, this house has now come down from $675 to $575 with 6.5% interest. Now it's at $3,500. Let's just say it's $50 off, but that's $1,050 in monthly payments at this price that this house has lost in the last week alone. I think that if they lower rates in September, that's going to further lower interest rates, but that's going to begin the signal to a bunch of buyers at, it's time to buy. Everything is lowering, and therefore we can get into the market and charge more. Then it's time to sell. I misspoke. It's time to sell at a higher price because interest rates are going down, which makes the monthly payments overall less. So my prognosis is that they didn't wait long enough. There's been some places that have lost up to 30% in their price, but let me find this. I don't think that that's going to be enough. There was a lot of different houses, luxury, those types of things that supported these high prices, and this is also for Southern California. But I think that it should have come down more towards $719 if we were being fair, or even $800 a square foot before the bubble is mostly wiped out from those inflated gains. We could come in and kind of draw a trend line here and just kind of looking at it, it'll be between $750 and $800 a square foot. So my thoughts are they pulled the trigger too soon on this. Everybody's expecting rates to come down in September. That'll drive down mortgage rates, which will probably send up housing prices again. If we see another couple of rates, I will come back and visit this, but I bet you that this will then go up to $1,000 a square foot. To $1,000 for the average house, and that's going to be up to $1 million. So this is a careful balance between interest rates plummeting, which then send houses up. And there's a magic moment there. What I recommend to everybody and my clients is be prepared. How far do I think federal rates are going to go down? I think that they're going to have a hard time. By the summer of 2025, I'm expecting them to be around 4.5% to 5%, which means that the mortgage rates will be probably in the 5 to 6%. How much will it have to offset that much? Let's go ahead and do the math. So if we say, let's just say you get a good loan at 5%, and it's going to be $3,000 a month for your monthly payments when it was $35,000. So if we bring this house, if this house that we were looking at goes back up to $675,000, let's just make it $650,000. So if they just lowered interest rates, let's pretend it goes down by 1%, but houses go up by $75,000, that's where you're going to be dead even on this. So really, what we need to be tracking now is rate of change between interest rates and prices. And when that bottoms out, that ratio, that's going to be the ideal time to buy. Okay, well, I hope you found this informative. If you have any questions or you'd like a personal analysis about housing or the market, feel free to reach out. All my information is below. Thank you much. Bye.